Hello and welcome to Module 2 titled Regulatory Framework on Financial Advice. My name is Max from Deep Learning Academy. In this module, we will cover the following topics: Principles of Ethics, the Financial Advisory and Intermediary Services Act, and anti-money laundering and counter-terrorism financing legislation. We will also cover further legislation impacting financial advisory services. Let's begin. Learning Unit 1. Principles of Ethics, Corporate Governance and Ethics. In South Africa, corporate governance refers to the mechanisms, processes, and relations by which corporations are controlled and directed. It involves balancing the interests of various stakeholders, such as shareholders, employees, customers, suppliers, and the community. Ethical corporate governance ensures that businesses operate with integrity, transparency, and accountability. For example, the King IV Report on Corporate Governance for South Africa emphasizes ethical leadership, responsible citizenship, and stakeholder inclusivity. Professional Codes of Conduct. Professional codes of conduct outline the ethical standards and behaviors expected of individuals within specific professions. In South Africa, various professional bodies have established codes of conduct tailored to their respective industries. For instance, the Engineering Council of South Africa, ECSA, has a code of conduct that guides engineers in upholding professional integrity, competence, and confidentiality in their practice. Organizational Code of Conduct and Value System. An organizational code of conduct outlines the principles and values that guide the behavior of employees within a company. It sets expectations for ethical conduct, compliance with laws and regulations, and interactions with stakeholders. For example, Woolworths, a prominent South African retailer, has a code of ethics and business conduct that emphasizes integrity, honesty, and respect in all business dealings. Developing and implementing a code of ethics. Developing and implementing a code of ethics involves defining the core values and principles that guide ethical behavior within an organization. In South Africa, this process may involve consultations with employees, management, and stakeholders to ensure buy-in and alignment with organizational objectives. Once developed, the Code of Ethics should be communicated effectively and integrated into organizational policies and practices. For instance, Nedbank, one of South Africa's largest banks, developed its Code of Ethics through stakeholder engagement and ensures its implementation through training programs and monitoring mechanisms. Conflict of interest. A conflict of interest arises when an individual or organization's personal interests or loyalties interfere with their professional obligations or responsibilities. In South Africa, managing conflicts of interest is crucial for maintaining transparency and integrity in business and governance. For example, public officials are required to disclose any potential conflicts of interest when making decisions that may impact the public interest, as mandated by legislation such as the Public Service Act and the Companies Act. Similarly, employees in private organizations are often required to disclose conflicts of interest to their employers to avoid compromising the organization's interests. Next, we talk about the FIS Act. Learning Unit 2. The Financial Advisory and Intermediary Services Act. Background to compliance legislation. Compliance legislation refers to laws and regulations designed to ensure that financial services providers operate ethically, transparently, and in the best interests of consumers. In South Africa, the need for compliance legislation arose from incidents of financial misconduct and consumer abuse. For example, the collapse of various financial institutions in the late 1990s and early 2000s prompted the government to enact the Financial Advisory and Intermediary Services (FIS) Act 37 of 2002 to regulate the financial services industry and protect consumers. Financial Sector Regulation Act 9 of 2017. The Financial Sector Regulation Act, FSR Act 9 of 2017 is a key piece of legislation that aims to strengthen the regulation and supervision of the financial sector in South Africa. It establishes the Prudential Authority and the Financial Sector Conduct Authority, FSCA, as regulatory bodies responsible for supervising financial institutions and market conduct, respectively. The FSR Act enhances financial stability and promotes fair treatment of consumers. FIS licensing requirements. The FIS Act imposes licensing requirements on individuals and entities that provide financial advisory or intermediary services in South Africa. To obtain a license, financial service providers must meet certain criteria, including qualifications, experience, and competency. For example, financial advisors offering investment advice must pass regulatory exams administered by the FSCA to demonstrate their knowledge and competence. Fit and proper requirements. The FIS Act sets out fit and proper requirements to ensure that individuals involved in providing financial services possess the necessary integrity, competence, and financial soundness. This includes assessing factors such as criminal record, financial stability, and professional conduct. For instance, individuals applying for FIS licenses must undergo background checks and disclose any disciplinary actions or conflicts of interest. Exemption of services under supervision. Certain financial services may be exempt from full licensing requirements under the FIS Act if they are provided under the supervision of a licensed financial services provider. This allows entities such as banks or insurance companies to offer limited financial services without obtaining separate licenses. For example, a bank may offer basic financial advice to its customers as part of its banking services without needing to be individually licensed under FIS. Enforcing the FIS Act and the FSR Act. The FIS Act and the FSR Act empower regulatory authorities such as the FSCA to enforce compliance with financial regulations and take action against entities or individuals that violate the law. This may include conducting inspections, investigations, and imposing sanctions for non-compliance. For example, the Eskom may revoke the license of a financial advisor found guilty of misconduct or impose fines on a financial institution for breaching consumer protection regulations. Consumer complaints. The FIS Act requires financial services providers to have effective complaints resolution procedures in place to address consumer grievances. Consumers who believe they have been treated unfairly or receive poor service can lodge complaints with the financial services provider or escalate them to the FSCA or the Ombudsman for financial services providers. For instance, if a consumer feels misled by an insurance policy sold by a financial advisor, they can file a complaint with the relevant authority for investigation and resolution. FIS General Code of Conduct. The FIS Act prescribes a general code of conduct that financial services providers must adhere to when dealing with clients. This code includes principles such as treating customers fairly, providing suitable advice, and disclosing relevant information transparently. For example, financial advisors are required to conduct a needs analysis and provide recommendations that are in the best interests of their clients, taking into account their financial goals and risk tolerance. Let's do a recap of the FIS Act. In this learning unit, we have covered the following: background to compliance legislation and Financial Sector Regulation Act of 2017, as well as the FIS licensing requirements, fit and proper requirements and exemption of services under supervision, as well as enforcement of the FIS Act and the FSR Act. We went on to discuss how we handle consumer complaints and the General Code of Conduct. Learning Unit 3. Anti-money laundering and counter-terrorism financing legislation. Background to anti-money laundering legislation. Anti-money laundering (AML) legislation aims to prevent criminals from disguising illegally obtained funds as legitimate income. In South Africa, AML laws were strengthened in response to concerns about financial crime and its impact on the economy. For example, the Financial Intelligence Center Act, FICA, was introduced to combat money laundering and terrorist financing by establishing measures for identifying and reporting suspicious transactions. Money laundering and financing of terrorism. Money laundering involves the process of concealing the origins of illegally obtained money, typically through a series of complex financial transactions. Terrorist financing involves providing financial support to terrorist organizations or individuals to facilitate acts of terrorism. For instance, criminals may launder money from drug trafficking through legitimate businesses or use financial channels to transfer funds to terrorist groups for purchasing weapons. The Financial Intelligence Center Act, FICA, 38 of 2001. FICA is a key piece of legislation in South Africa that establishes the Financial Intelligence Center, FIC, to combat money laundering and terrorist financing. FICA requires financial institutions and other accountable institutions to identify and verify the identity of their clients, monitor transactions for suspicious activity, and report such activity to the FIC. For example, banks must conduct customer due diligence and report any transactions that appear unusual or suspicious. Prevention of Organized Crime Act, POCA, 121 of 1998. POCA is another important law in South Africa aimed at combating organized crime, including money laundering. It provides law enforcement agencies with powers to investigate and prosecute individuals involved in criminal activities. For example, POCA allows authorities to confiscate assets acquired through illegal means and prosecute individuals for money laundering offenses. Protection of Constitutional Democracy Against Terrorist and Related Activities, Act 33 of 2004. This act focuses on combating terrorism and related activities in South Africa. It criminalizes various terrorist-related offenses and provides law enforcement agencies with tools to investigate and prosecute individuals involved in terrorist activities. For example, the Act allows for the freezing of assets belonging to suspected terrorists and the designation of individuals or groups as terrorists. Effects of money laundering on the economy. Money laundering has detrimental effects on the economy, including undermining the integrity of financial systems, distorting competition, and facilitating corruption. For example, if illicit funds are laundered through legitimate businesses, it can distort market competition and create unfair advantages for those involved in criminal activities. Additionally, money laundering can weaken investor confidence and deter foreign investment. Personal liability for non-compliance. Individuals and entities involved in the financial sector may face personal liability for non-compliance with AML laws. This can include criminal prosecution, fines, and reputational damage. For example, if a bank fails to implement adequate AML procedures and facilitates money laundering, senior executives or compliance officers may be held personally liable for their negligence or misconduct. We do a recap of what we covered in this unit. Background to anti-money laundering legislation. Anti-money laundering, AML, legislation aims to prevent criminals from disguising illegally obtained funds as legitimate income. We explained money laundering and financing of terrorism and said money laundering involves the process of concealing the origins of illegally obtained money, typically through a series of complex financial transactions. To prevent money laundering, we have the Financial Intelligence Center Act 38 of 2001. FICA is a key piece of legislation in South Africa that establishes the Financial Intelligence Center, FIC, to combat money laundering and terrorist financing. Prevention of Organized Crime Act, POCA, 121 of 1998. POCA is another important law in South Africa aimed at combating organized crime, including money laundering. Protection of Constitutional Democracy Against Terrorist and Related Activities, Act 33 of 2004. This act focuses on combating terrorism and related activities in South Africa. Effects of money laundering on the economy. Money laundering has detrimental effects on the economy, including undermining the integrity of financial systems, distorting competition, and facilitating corruption. 7. Personal liability for non-compliance. Individuals and entities involved in the financial sector may face personal liability for non-compliance with AML laws. This can include criminal prosecution, fines, and reputational damage. Next, we discuss further legislation impacting on financial services introduction. Learning Unit 4. Further legislation impacting on financial services introduction. Insurance Act 18 of 2017. The Insurance Act of 2017 regulates the insurance industry in South Africa, ensuring fair treatment of policyholders and stability within the sector. It sets out requirements for the licensing, governance, and conduct of insurance companies. For example, the Insurance Act mandates that insurance companies maintain adequate reserves to cover potential claims and comply with capital adequacy requirements to safeguard policyholder interests. Promotion of Access to Information Act 2 of 2000. The Promotion of Access to Information Act, PAIR, promotes transparency and accountability by granting individuals the right to access information held by public and private bodies. It allows individuals to request access to records held by financial institutions, subject to certain exceptions and limitations. For example, a consumer may submit a PAIR request to a bank to obtain information about their credit history or account transactions. Protection of Personal Information Act 4 of 2013. The Protection of Personal Information Act, POPIA, aims to safeguard the privacy and security of personal information processed by public and private entities. It establishes principles for the lawful processing of personal data and imposes obligations on organizations to protect individuals' privacy rights. For instance, financial institutions must obtain consent from customers before collecting, storing, or sharing their personal information and implement measures to prevent data breaches. National Credit Act 35 of 2005. The National Credit Act, NCA, regulates the credit industry in South Africa, promoting responsible lending practices and protecting consumers from unfair credit practices. It sets out rules for granting credit, disclosing loan terms, and resolving disputes between lenders and borrowers. For example, the NCA requires lenders to conduct affordability assessments before extending credit to ensure borrowers can repay their loans without financial hardship. Consumer Protection Act 68 of 2008. The Consumer Protection Act, CPA, enhances consumer rights and ensures fair treatment in transactions involving goods and services. It prohibits unfair business practices, such as false advertising, deceptive marketing, and unfair contract terms. For instance, the CPA allows consumers to cancel fixed-term contracts without penalty under certain circumstances and provides remedies for consumers who suffer harm due to product defects or poor service quality. Financial Institutions, Protection of Funds, Act 28 of 2001. The Financial Institutions, Protection of Funds, Act, FIPFA, protects the funds of customers held by financial institutions in South Africa. It establishes mechanisms to safeguard client funds and ensures that customers are compensated in the event of a financial institution's insolvency. Financial Markets Act 19 of 2012. The Financial Markets Act, FMA, regulates financial markets and market infrastructure in South Africa, promoting transparency, fairness, and efficiency in trading activities. It governs the operation of exchanges, trading platforms, and clearinghouses, as well as the conduct of market participants. For instance, the FMA requires financial market operators to maintain fair and orderly markets, prevent market abuse, and disclose relevant information to investors. Pension Funds Act 24 of 1956. The Pension Funds Act regulates pension funds and retirement savings in South Africa, ensuring the security and sustainability of retirement benefits for members. It sets out rules for the establishment, governance, and administration of pension funds, as well as the management of pension fund assets. For example, the Pension Funds Act requires pension funds to prudently invest members' contributions and provide regular updates on fund performance and benefits. Collective Investment Schemes Control Act 45 of 2002. The Collective Investment Schemes Control Act, CISCA, regulates collective investment schemes, CIS, in South Africa, such as unit trusts and exchange-traded funds, EPS. It aims to protect investors by ensuring that CS are managed and operated in a transparent, fair, and efficient manner. For example, CISCA requires CS managers to provide investors with accurate and comprehensive information about fund objectives, risks, and fees before investing. Electronic Communications and Transactions Act 25 of 2002. The Electronic Communications and Transactions Act, ECTA, regulates electronic transactions and communications in South Africa, providing legal recognition and validity to electronic contracts and signatures. For example, ECTA ensures that electronic transactions are secure, reliable, and enforceable, thereby facilitating e-commerce and digital innovation in the financial services sector. Thank you for watching. Good luck with your studies and see you in the next module.